are going to cover FIRPTA today. Every time I say FIRPTA, I feel like I should say excuse me. It sounds like a hiccup or a burp. What we're going to talk about specifically is understanding FIRPTA, the Foreign Investment in Real Property Tax Act. It is when you're looking through contracts, there is always language on FIRPTA, because if you are a foreign individual who owns property in the U.S., you're subject to this Foreign Investment in Real Property Tax Act. Hopefully you knew that going into the purchase. If not, I'm so sorry that somebody didn't cover that with you, but it is so important to know, at least now or for future planning. So real estate investment has obviously long been a popular choice for investors seeking stable and potential lucrative returns. It's how a lot of people have made their money or secured their assets. And in the United States, both domestic and foreign investors participate in the real estate market. Now, it's been a little bit slower if you're listening to this and it's still 2023. We've been a little bit slower this year. But it still remains a great place for foreign investors. And an investor doesn't mean an investor the way we think of it as somebody who's in it to make money. An investor is a foreign person who is purchasing real estate in the U.S. for what we're talking about today. However, when it comes to foreign investors, there are specific tax regulations in place to ensure that the government receives its due taxes. The government is not going to let somebody come in and purchase and then sell a real estate property and not pay the same taxes that they would expect others who live here full time to do. So one such regulation is FIRPTA. We already talked about that. Stands for Foreign Investment in Real Property Tax Act. In this blog, we're going to delve into the key aspects of FIRPTA, its purpose, and its implication for foreign investors in U.S. real estate. So let's start with the what is it? FIRPTA stands for, as I already said 2 times, Foreign Investment in Real Estate Tax Act. It's a federal tax law enacted by the U.S. Congress. It was enacted in 1980, and its primary purpose is to ensure that foreign investors who profit from the sale of U.S. real property interests pay their fair share of taxes to the U.S. government. FIRPTA is administered by the IRS, Internal Revenue Service, and it applies to a wide range of real property transactions involving foreign investors, foreign owners. Let's talk about the key provisions of the Tax Act. 1. Taxation of gains. Under FIRPTA, any foreign person or entity that disposes of U.S. real property interest is subject to taxation on the gains from that disposition. This means that when a foreign investor sells U.S. real estate, they may be liable for capital gains tax. 2. Withholding requirements. To ensure compliance with FIRPTA, the law requires buyers, known as the withholding agents, to withhold a portion of the sales proceeds to remit it to the IRS. That withholding rate is generally set at 15% of gross sales price, although it can vary depending on specific circumstances. So keep that in mind. It doesn't mean you always owe 15%. It means that they will withhold 15% at the front end to make sure there are sufficient funds in place to cover what the liability for taxes is. 3. Exemptions and exceptions. So FIRPTA includes certain exemptions and exceptions that can reduce, eliminate, or in some cases eliminate the withholding requirements. We talked about the withholding requirement being 15%. For example, transactions involving a U.S. corporation or a publicly traded partnership may be exempt from withholding. As with any of these things, I'm going to say this probably again towards the end, make sure you are working with a qualified CPA. Your real estate agent is not a tax professional. They are not a tax expert. I am not a tax professional or tax expert. This is something that needs specific expertise in the form of a CPA or an accountant, obviously, and there are some specialized ones. We've got one, for example, called the FIRPTA Group, and they're in Naples, and they do a lot of work. In fact, they have a calculator that I will attach to this blog for helping you compute what your anticipated obligation is going to be, but make sure you're working with somebody who's qualified. 4, reporting requirements. So the act rather, has a requirement that both the buyer and the foreign seller must report the transaction to the IRS using Form 8288 and Form 8288A. Respectively, these forms help the IRS track real estate transactions involving foreign investors and ensure proper tax collection. So what are the implications of FIRPTA for foreign investors? Foreign investors in U.S. real estate should be aware that these implications are present. So one is the tax liability. Foreign investors may incur capital gains, as we've already talked about, on the sale of the U.S. property, and then the withholding requirement can result in a substantial upfront tax payment. Some people may not realize that that has to be withheld up front, regardless of what your ultimate obligation will be. 2, complex compliance. So FIRPTA compliance can be complex, as it involves understanding the law's provisions, determining withholding amounts, and fulfilling reporting requirements. Failure to comply can lead to penalties and interest charges. So that's why it's so important to work with a qualified professional to get ahead of this before you're reacting to it. 3, seeking legal advice. Given the complexity of FIRPTA, foreign investors are often advised to seek expertise of tax professionals, which I've already talked about, but also keep in mind there may be a need to consult with legal experts who are well-versed in the U.S. tax laws, real estate transactions, particularly involving foreign investors. So FIRPTA serves as an important tax regulation that ensures foreign investors in U.S. real estate contribute their fair share of taxes, as I've talked about. While it may add complexity to real estate transactions, compliance is so critical to avoid legal and financial repercussions. Foreign investors should carefully navigate the FIRPTA requirements, seek professional guidance when necessary, and stay informed about any updates or changes to the law to make the most of their real estate investments in the U.S. And the last thing I'm going to throw in here is this is very much reads as though it is all on the shoulders of the seller, and that is true. The tax obligation is that of the seller. But it is equally important that the buyers maintain some level of awareness and knowledge, because if for some reason you don't notify your closing company that you are purchasing the property from a foreign investor, and if then that closing company does not withhold that 15% or whatever it might be in the specific case, that obligation for those taxes passes on to the buyer, period. So if your closing company isn't collecting the anticipated taxes up front and you close the deal, sorry, that means you are now, as a buyer, obligated. If that didn't get your attention, I don't know what will. So make sure you're getting advisement. It is the responsibility of the sellers to disclose that they're a foreign owner. There's actually, in our local contracts, a disclosure that's required. But there are lots of different ways that one should try to validate, including using the closing company to help as well, to make sure that you know if you're doing business with a foreign investor, foreign owner of real estate. Thanks, and I hope this was helpful.